Well, the buying of stocks selling at a discount to working capital that Ben Graham was finding that they're just not there. And then we all know Buffett came on board, and he would pay up for a business relative to the criteria of pure Ben Graham value investor, if there was the protective moat and he could see margins remaining intact and could continue into the future. And you've had to make adjustments, and I think value investing for me, it's kind of morphed into somewhat relative value investing, because you can't find the pure discounts to working capital that Ben Graham was finding, but some of the postulates still keep you out of trouble. To the extent you can, you want to find something cheap that has that margin of safety, because I think it's Buffett, two rules. First rule is don't lose money, and the second rule is don't forget the first rule. And so even when I'm taking, with small amounts of capital, intelligent speculations, or I may be creeping into relative value investing, you always come back to the safe harbor as, if this thing goes wrong, what is my downside protection? What is the strength of the balance sheet? How much debt is there? And it has been able to keep me out of trouble, even though I have had to tack away from, pure only buying things that are discounts to book value. The world from that standpoint has changed, and I've had to adapt, and it's worked.